Hello everyone. Welcome to another OctaFX webinar. Today we're going to be looking at we're going to be having an online workshop for complete beginners, and this workshop is going to contain awesome topics that you don't want to miss out on, regardless of your level in forex markets. Today we're going to be looking at forex fundamentals, and before I go into the talking points of this webinar, I would like for you guys to type in the comment section your name and where you're watching from. You can also go ahead to tell me how long you've been trading the forex market. Okay, so today we're going to be looking at some nice topics. We're going to talk about forex and how you can earn from the financial market or the forex market. We're going to talk about liquidity, and I'll explain brokers in detail for you guys. And we're also going to look at volatility and currency pairs. Okay, we have Anthony Root from India. Wow, we have Abayomi Saka from Nigeria. We have Ayodele Oshaniwa. Welcome. We have Vijay from India. Goswill from Kogi. We have Eze Lucas from Nigeria. Eze Lucas says he has been trading the financial market for 2 years. Okay. Jerry from Kaduna, and Charles from Lagos, Princess from Aba, Ruth from River State, Nigeria. Okay, massive welcome to you guys. I hope you guys enjoyed your holidays. So I'm just going to go ahead to the content of today's webinar. If I keep welcoming you guys, we're not going to leave here today. Okay, the first thing is, what is forex and how can you earn on it? The forex market, or the foreign exchange market, which is usually known as forex or FX, usually abbreviated by FX, is the largest financial market in the world with a $6.6 trillion day trading volume. Now, this huge $6.6 trillion day trading volume covers the entire global financial market, but the spot market, which is relevant to most forex traders, is smaller at $2 trillion per day. The forex market is open 24 hours a day and 5 days a week from 5 p.m. EST. EST means instant time. So from 5 p.m. EST on Sunday until 4 p.m. instant time on Friday. Now, how can you earn from the forex market? The basic definition on how you can earn from the forex market is you're exchanging, two currencies, right? So you're buying one currency relative to another currency at a particular exchange rate to sell that same currency if the exchange rate increases, so that you can make profit. I'll use this example to show you guys what I mean. So we have euro against the US dollar. Now, the exchange rate for euro dollar is, in this example, is 1.18. Now, an exchange rate is the relative price of two currencies from two different countries. Now, we have euro and dollar, right? So the exchange rate for euro dollar in this example is 1.18, and if I'm to exchange 10,000 euros for dollar, all I just have to do is to multiply the amount I want to exchange, which is 10,000 euros, by the exchange rate for the currency pair euro dollar, right? I'm going to get the amount in dollars I would get if I do this exchange. Now, how do I profit from exchanging? This is what was happening. Now, in order for me to profit from the exchange rate, I would have to hold on to this currency pair, to this currency that I've exchanged, to sell when the exchange rate increases. Now, if I'm selling my dollar, if I'm selling this dollar back to euro and the exchange rate is at 1.25, I'll be making $12,500. Now, let me use my calculator to show you guys what I mean. So the exchange rate is 1.18, right? And I'm exchanging 10,000 euros. So I multiplied the exchange rate by the amount that I'm willing to exchange. and this is going to give me $11,800. Now, if the exchange rate increases and I want to change this same amount, 10,000 euros to USD, if the exchange rate is at 1.25, as we have in the example here, 1.25 multiplied by 10,000 euros. Now, instead of the initial 0.25, instead of the initial 11,800 that I had, I'll be having 12,500. That's extra $700 just because I held onto USD, right? Okay. The objective of Forex trading is to exchange one currency for another in the expectation that the price will change. More specifically, that the currency pair or the currency you bought will increase in value compared to the currency you sold. Okay, I think that's pretty understandable. The next thing we're going to talk about is understanding liquidity. Now, I'll be constantly checking the comment section to see if you guys have questions. So at any point in time, if you have any questions, you can just type your question in the comment section and I would go ahead to answer that question. Okay, so what is liquidity and why is it an important feature in Forex? Liquidity refers to how quickly and at what cost one can sell an instrument. It's also the measure of how many buyers and sellers are present in the market and whether transactions can take place easily. Now, we have two types of liquidity: high liquidity and low liquidity. Before I go ahead to explain these two types of liquidity, I also want you guys to know that usually liquidity is calculated by taking the volume of trades or the volume of pending trades currently in a market. Now, high liquidity is when there is a significant level of trading activity. By significant, we mean a high level of trading activity, and when there is both high supply and demand for an instrument or an asset. It could be a currency pair, it could be a commodity like gold, or a stock, whatever market it is. As long as there's a high supply and demand for that asset, it's going to be easier for you to find a buyer and a seller, and you can classify that market as a high liquid market. While low liquidity is when there are only a few market participants trading infrequently. There's not much level of trading activity going on in that market. It's known as an illiquid market. Now, a high liquid market increases the probability that a buyer and a seller will be happy to exchange at their rates. For example, a buyer would be happy to buy at the rate of a seller, and a seller would be happy to buy at the rate of a buyer. These prices would move closer. That's one advantage of high liquidity. Okay, if you're trading the Forex market at odd hours, let's say when the market is just opening, you notice that there will be few market participants, and the candlesticks or the market is going to be moving. The market prices will be moving slowly. Okay, let's look at the importance of liquidity. Why is liquidity an important feature in Forex? Number one, a liquid market is associated with the other side of a given position. Now, liquidity is important in Forex for numerous reasons, but basically because it impacts how quickly you can open and close your positions. You know how you open your trading app and you're like, okay, you've done your analysis, you want to, let's say you want to buy pound dollar, and you don't have to wait for 5 hours, 2 hours before your order is being executed, right? Once you click on market execution, you click on your buy, it goes straight. That's because the Forex market is highly liquid. It's considered as the highest as a financial market with a very high liquidity. Okay, number two is, in a liquid market, the bid offer spread will tighten while in an illiquid market, the bid offer spread will widen. I gave an example on when the market opened. You notice that not a lot of people are trading at that time. You would also observe or notice that the spreads are a little bit wide. They're not closer. But when, let's say, at the open of London session or the New York session, you see that a lot of traders are getting involved with the market or with those currencies, and then the spreads tend to tighten. Okay, let me see if you guys have questions before I talk about the third important. Okay, the third one is it tends to reduce the risk of slippage, and it gives faster execution of orders and tighter bid offer spreads. Now, if you don't know what slippage is when you execute it, when you place an order, but the order is being executed at a different price other than the price that you placed this order. So let's say the chart here is CADJPY, which is the Canadian dollars against the Japanese yen. And let's say, for example, I am executing a trade here. If you look towards the right, you're going to see the figure. It's 91.56, right? Now, when a slippage occurs in a trade, this particular order that I've placed would not execute at 91.56. That is right here. It's going to execute, maybe if it's a buy trade, it will execute lower or higher. It can just execute at a different price other than the price that I placed the order. So that's what a slippage is. And it also gives faster execution of orders and tighter bid offer spreads. Okay, so these are the importance of liquidity in the Forex market. I'm just going to check if you guys have questions, and I would go into... Yeah, the most important thing to note about our market liquidity is that it's not necessarily fixed. Liquidity is dynamic. It's constantly shifting from high liquidity to low liquidity. You cannot have just a market that is just highly liquid at all times. Sometimes it goes from high liquidity and then goes to low liquidity. Okay, someone is asking what currency pair is. What currency pair has the highest liquidity? Okay, Euro USD. The Euro USD currency pair is considered the most liquid currency pair in the world, and it's followed by USD/JPY, which is the second most popular currency pair in the world. Okay, so we're going to talk about brokers. What is a broker? A broker serves as the intermediary, the middleman between you and the Forex market, just like you have in this illustration right here. You see that the broker is the guy in blue. He's serving as the middleman between you and the Forex market. Now, see a broker as this. Let's say, for example, I'm a skillful footballer. I know how to play football. Now, if I want to play against big teams in major leagues, I would have to get signed into a club that is going to provide me with jerseys, shin guards, my boots, that's going to train me, in order to play against this big teams in major leagues around the world. So that's just how that's what your broker acts like. Forex brokers are firms that gives you access to the Forex market by providing a trading account for you. They also provide leverage and support functions to traders. Now, OctaFX goes as far as providing extra Forex trading services, educational resources, webinars, and trading tools that would immerse you in a positive trading environment till you're fully ready to trade on a live account. Okay. Let's see if you guys have questions. Okay. How can a Forex broker help you enter the Forex market? The first one is they provide you with a trading account. In order to trade in the financial markets or the forex market, you need to have a trading account, right? Second one is provide you with fast trade execution and leverage. So you don't have to wait for 2 days if you place a buy, and you don't have to wait for 2 days for your buy order to be executed. Forex broker also provides you with leverage for you to choose. You have different options different leverage options that you can choose from. In OctaFX, you can choose from, I think you choose the highest leverage you can choose is 1 to 500, and I have a webinar that talks about leverage. So in the description of this video, you're going to see a playlist, an English playlist, that will direct you on how you can understand leverage. The third one is spreads. Spread is the difference between the ask price and the bid price. It's just like your bank. If you're going to exchange, let's say you're going to exchange your dollar for euro, the bank is going to have a certain price. They'll buy your dollar from you and give you euro, and they will have a certain different price that they would sell your dollar to you if you're coming with euro. Okay. The fourth one is your broker provides deposit and withdrawal options. OctaFX has multiple deposit and withdrawal options down to local bank transfer for Nigerians. The fifth one is support functions. By support functions, I mean if you're not understanding or you're not familiar with your dashboard, or you're not familiar with the environment on the website, you can easily click on the live chart. You can easily send an email and you'll be responded to quickly. Okay, let me see if you guys have questions. Okay, Azay is asking how to create a demo account. It's pretty simple. I think it's just 4 steps with OctaFX. So you just want to go to octafx.com and you open an account. Once you open an account, fill in your details, the correct details, and they'll send your trading account details to your email. It's like 3 or 4 easy steps that you can use to create a trading account. Okay, so we're going to look at currency pairs. What is currency pairs, or what are currency pairs? A currency pair is the quotation of 2 different currencies with the value of one currency being quoted against the other. The first listed currency of a currency pair is called the base currency, and the second currency is called the quote currency. A forex quote consists of 2 currencies. A currency pair consisting of a base currency, like I said, and a quote currency, which is also called the counter currency. Now I'm going to show you guys an illustration. Okay. On a currency pair with base, on a currency pair that has the base and the quote. But before that, let's talk about these 7 major currency pairs that you need to know as a beginner trader. The first one is Euro USD. You have GBP USD, you have USD CHF, which is the Swiss franc, you have USD JPY, AUD USD, NZD USD, and USD CAD. Okay, these currency pairs also have nicknames, like the dollar is called the greenback, pound is called cable, NZD is called the Kiwi. We also have a video on that if you click on the English playlist in the description. Okay, so in this illustration right here, you have the first currency, which is Euro, and USD, which is the currency it is quoted against. Now this first currency is called the base currency, and the second one is called the quote currency. Now usually when you see currency pairs like this, you would also see a price by their side. What does this price mean? It means the amount of the quote currency you would need to get one of the base currency. For example, you have Euro USD, and the price that is beside Euro USD is 1.4745. 46. Now this 46 is the ask price. Remember, these currency pairs are differentiated by two prices: the ask price, which is the price that the ask price, which is the price that which is the base currency, and the bid price is the amount of euro that you can sell your dollars for. So in the currency pair, the ask price determines how many amount of this quote currency do I need to buy one of the base currency. Let me know if you guys understood that. Okay, someone is asking, is this section recorded for? Yes, the recording of this video would be saved for you guys, so you can watch and rewatch. Okay. We're going to talk about volatility. What is volatility? Now, volatility is a measure of the amount by which price fluctuates over a given period. If the market's never moved, then nobody's going to make money, right? So volatility is the measure of the amount by which price fluctuates, by which price moves up and down over a given period of time. When a currency price fluctuates wildly up and down, it's said to have high volatility. And when a currency pair does not fluctuate at much, let's say for example, at the initial on Sundays, when markets open, price doesn't move, as fast as it does during, let's say, the opening of London session or New York session. So when a currency pair doesn't fluctuate as much, it is said to have low volatility. Before I talk about how you can benefit from volatility, if you're looking to trade, a fast-paced instrument like a currency pair that has, high volatility, or a currency pair that changes in directions and have, multiple exits and entry points, then you should look to trade pairs that are associated with GBP or gold or commodities like gold. But if you're choosing, or if you choose to trade a slow-paced trending instrument, then you should look to trade in currencies that are associated with the Swiss franc or CFDs on the global stock indices. So how do you benefit from volatility? The first one is to make sure you're comfortable trading when volatility is high. Now, before you attempt to trade in high volatile markets, you should make sure that you're mentally and tactically prepared, and you also note how volatile a currency pair is before you decide to open a trade. The second one is to ensure you recognize the potential for significant loss of capital and are prepared for this additional risk. In other words, we're trying to say use solid and proper risk management. When we talk about risk management, a lot of you guys just think it's using stop loss and take profit. No, it also includes your position size, your lot size, using the adequate lot size for your trading account. Okay, if you're trading $100 account, you don't need to start using a standard lot, for a $100 account. So use the adequate lot size for your trading account. The third one is focus on trending markets. Despite high overall market volatility, some markets can still exhibit strong trending activities. Now, for a buyer, you're looking to trade a market that has been trending upwards but has not accelerated its pace, it has not made any significant or solid, strong, move to the upside. And for a seller, you're looking to trade. For a seller that's looking to trade a volatile market, you're looking to observe, markets that have been declining or trending downwards, but hasn't, experienced a huge fall or huge collapse to the downside. The idea is to get into these trades at the breakout or breakout and retest, and ride in profit, not to get into this trade once or after the breakout. right? So you're looking to for a buyer, you're looking for confirmations that an uptrend or a trending market, that's a market that's trending upwards. I'm looking for confirmations that would indicate, strong momentum to the upside, and you join before, the candle moves up significantly. And the fourth one is to watch out for breakouts from consolidations. Now, breakout strategies is one of is a very common trading method used by traders. With the breakout strategy, a trader is identifying or looks to identify, markets that is trading or moving in a range, moving significantly in an identifiable support and resistance zone. And as long as this market is moving in this, significant support and resistance zone, the trader does nothing, right? As for breakouts, you're looking to trade at the breakout of that range. I'm going to explain again. Now, for a breakout, for the breakout strategy, you're looking for markets that is trading within an identifiable support and resistance range, right? As long as market moves in that range, you do nothing. You're looking for a breakout, could be to the upside, could be to the downside. Looking for a breakout and possibly a retest to the previous resistance before you look to trade in the direction of the breakout. Okay. Fifth one is consider short-term strategies. Now, most times when markets are volatile, it could be after a news has been released. The market doesn't really go straight in one direction and trend in that direction. Markets could just move. Market could just move upwards and come back to the original price it was before it made that breakout, or before it made that strong or solid move, and go back to move upwards. Let me give you guys an example of what I'm trying to say. Okay, so markets can just decide to move up and retrace and come back to, let me see if I have an example that shows. Okay, let's take this point for example. So let's say you are in this market, right? And you are on a buy. Now, if you notice, market moved upwards, came back to the initial point it was before this move. It moved upwards, came back, and continued, that initial upward movement. So in a volatile market, you don't just start looking for analysis that would indicate a long-term movement of the market. You don't start looking for or applying strategies that would indicate, long-term market movement at once. You're looking to apply short-term strategies, follow the market as it breaks out, and use your trailing stop. Your trailing stop is, let's say, for example, is the horizontal line. Okay, so let's say where you have this horizontal line, this red horizontal line is where I placed a buy, right? I'm going to use another line for stop loss. So let's say I placed this buy at this red horizontal line, right? And my stop loss was below. Now market moved upwards. Yeah, so market moves upwards. If you look to the right, you're going to see that this buy was activated at 90.90, right? 90.90, and market got to this point. So let's say my take profit was not at that point. Let's say my take profit was somewhere around here, right? And market got to this point before making a retracement and start going back up again. So let's say market got to this point. In order to apply a trailing stop, I'll take my stop loss, which I set at 90.76. That's less than 20 pips. That's like 24, 23 pips. I take my stop loss and I put it in profit so that I can be able to secure some profit. So if this market decides to come down, it doesn't take me out at break even, or it doesn't take me out at a loss. It doesn't go straight down to hit my stop loss. I'm securing some profit. And yes, you can put your stop loss in profit, but that is only after your trade has entered or your trade is moving in your direction. So for this illustration, the trade was executed at 90.90, and if you notice, market is moving in this buy trade was executed at 90.90, and if you notice, market is moving upwards, moving in my direction. Now I can easily decide to take my stop loss and put it in profit. Now as the market goes further, I can trail my stop loss further in profit. As the market goes up, I can trail it. So you see this pullback right here, it wouldn't have affected me so much because I had already secured some profits. Okay, so this is what using a trailing stop means. This is what we mean by using a trailing stop. Someone is saying, how long will it take to trade and make profit? It all depends on your confidence level. If you learn and constantly practice strategies that you've learned, it all takes your confidence. When you decide that I'm confident to start trading right now because I've practiced and practiced, I'm confident to start now or to start trading on my live account right now. So it all depends on your confidence level. And the sixth one is, when in doubt, wait it out. If you want to trade a volatile market, and let's say you're a chart pattern trader, or you're a zone trader, and you're not really sure about the zones that you're seeing, or you're not really sure about the chart pattern that is forming, you don't need to assume that it is going to form a double bottom if you don't see a double bottom. You don't need to assume that it's going to form a head and shoulder pattern if you don't actually see a head and shoulder pattern. Okay, so whenever you doubt what the market is doing at a particular time, you can just wait it out. Wait till market forms, makes that chart pattern, gives you that confirmation before you can hop on the trade. You don't necessarily need to start assuming that it's going to do this, so I want to hop on this trade and catch a few pips before it does. Nah, don't do that. Okay. So I'm just going to use the next few minutes to answer your questions. If you have any questions, you can go ahead and type in the comment section below, and I'll answer your questions. And don't forget that if you watch the whole series of the online workshop for complete beginners, you're going to get 100% single use deposit bonus on your trading account when you decide to start trading. And you're also going to get a PDF that's going to contain useful and valuable tips that will guide you on your journey to become a profitable trader. Okay, Nomzi is saying, does the broker protect the trader from risk? You give your orders to the broker, right? So if you open a trade, and you don't apply any stop loss, or you don't apply take profit, your trade is just going to be running because you just opened the trade, right? If it goes into profit, you haven't given the broker an order to close your trade in a specific level or a specific amount of profit, or to close your trade in a specific amount of loss. So you have to give your broker an order. You gave the broker the order to execute a trade. You also need to give the broker to stop you if you lose some kind of money, or to close the trade in profit if you're getting some kind of money. So when you give your brokers these orders, they help you protect you from losing all your funds, or losing an amount of money that you don't want to lose. Okay. Buyer is saying, will the market close at stop loss and take profit? I think by market you mean will your trade close at stop loss and take profit? Yes, if you place a trade and your take profit level is achieved. By achieved, I mean if the market moves from the initial point or your entry point and it hits your take profit level, your trade is closed, right? You've given the broker an order to close your trade in this amount of profit. If the trade goes against you and you have your stop loss level set, 20 pips, 30 pips away from your entry point, if the market hits your stop loss, then the trade is closed, right? So you don't end up losing so much money on that trade. Okay. Please, what is the best lot size for a $100 account? You should look to use a micro lot, right? 0.01. Okay. Okay, I'm just going to take one more question and then we're going to wrap up. Daniel says, buy limit not executed during trading session. Why? For your buy limit to be executed, market has to get to the point that you placed that order. If market doesn't get to that point, then it's not going to be executed. Okay, so that's it on today's session. I'll see you guys in the next webinar.